In this video, I'm going to explain what depreciation is and cover two methods commonly used to calculate it. These are the straight line method and the reducing balance method. Both will be covered with clear examples. What is depreciation? Depreciation is how much the value of an asset falls over a period of time. In order to record this expense to a business on an income statement, you can either use one of two key methods. First is the straight line method, and secondly, the reducing balance method. This is an important expense to consider for a business, as it can be costly if not monitored. For example, imagine if a business has a fleet of 10 vans that delivers products to its customers. If each of those vans depreciates by £2,000 that year, then this has a cost to the business of £20,000. It's important that a business records this expense, as it will provide them with a truer picture of their overall expenses. The first method a business can use to calculate the depreciation of its assets is the straight line method. The calculation you need to know to do this is the historic value of the asset minus the residual value divided by the expected life of the asset. This itself means nothing without an example. So, a bakery buys a new asset in the form of a new van to deliver its products to its customers. They purchase this van brand new for £30,000. This is the van's historic value. The historic value is the value of the asset when initially purchased. They expect the van to sell at the end of its use for £10,000. This is the van's residual value. Residual value is the value of the asset when it's disposed of by the business, i.e. sold on. Finally, they plan on using the van for 4 years. This is the van's expected life. The expected life of an asset is how many years the business expects to have the asset before it's sold on or disposed of. These numbers are then put into the calculation above. £30,000 minus £10,000 equals £20,000 divided by 4. This equals £5,000. This means that the depreciation of the van each year for a duration of 4 years is £5,000. This figure is a yearly expense to the business and is recorded as depreciation on a statement of comprehensive income. In order to apply your knowledge of straight line depreciation, there is a task sheet to complete in the description of this video. Why not have a go at a few examples? The next method of calculating depreciation is the reducing balance method. And rather than calculating the asset will reduce by the same amount each year, this method is calculated by reducing the value of the asset by a set percentage each year. In order to do this, you first take the historic value and times that by the percentage the asset will fall in value that year. This is then repeated each year for the duration of the asset's life within the business. Let's take the same scenario as we used for the straight line method. A bakery has purchased a van for its deliveries for £30,000. This means the historic value is £30,000. They expect the van to depreciate by 20% per year for the duration of its 4-year expected life within the business. The table shows how this calculation looks over the van's expected life of 4 years. We times each starting value by 0.2, as this is the multiplier that gives you a value of 20%. For example, if we wanted to reduce the balance by 10%, we will multiply the figure by 0.1. In year 1, the historic value of the van is £30,000. To find the depreciation that year, you multiply that by 0.2, which gives you a depreciation for that year of £6,000. We then find the value of the van at the end of that year by using the value at the start of the year, which is £30,000, and subtract the depreciation just calculated of £6,000. This gives an end of year value of £24,000. This value is then carried over to the start of year 2, as that is now the van's value at the start of the second year of its life. You then continue to depreciate the van by 20% each year until the van has reached the end of its expected life. As you can see, the residual value after 4 years of reducing balance depreciation is £12,288. The business will record larger expenses in terms of depreciation in the first year of the van's life. As the name suggests, each year this will reduce until the van is sold or no longer in the business. Unlike the straight line method, where each year the business will record the same rate of depreciation. If you would like to have a go at reducing balance depreciation or straight line depreciation, don't forget to download the task sheet in the video description. Thank you for watching, and if you found this video useful in terms of helping you understand straight line and reducing balance depreciation, then give the video a thumbs up and don't forget to subscribe.